The Bank of England has two jobs: to keep inflation low and to maintain financial stability. Today, despite the recent turmoil in global markets, the bank said inflation remained Britain's biggest risk. Interest rates were hiked for the 11th time, up to 4.25%, the highest rate since 2008, and adding to the cost of living pressures for companies and households. But will today's rate rise be enough to tame inflation?
We've seen signs of inflation really peaking now, but of course it's far too high. Now, we think it's going to come down sharply, really from the early summer onwards. But we haven't seen that happen yet. We had some news this week which was unfortunately going a bit the other way. We think there's probably some one-off elements of that. But we need to see it starting to come down progressively and get back to target.
The problem is that recent weeks have seen 3 global banks collapse, raising the spectre of another financial crisis. With many complaining financial weakness was the fault of rapid rate rises across the world and calling for central bankers to ease off. But the Bank of England governor dismissed claims of bank fragility in this country.
I don't think it's a repeat of 2008 at all. Yeah, we've obviously increased the regulation of the banking system since then. We learned a lot of lessons in the financial crisis, but I'm confident that the banks in this country are in a much stronger position.
But it's not just the world of high finance that's struggling to get to grips with steeper interest rates.
Hello. Hiya, Harry. How are you, mate? How are you? Yeah, good.
At the heart of Duke Street Market in Liverpool, restaurateur Harry Marquardt says that his customers are feeling the pinch.
Well, everyone's been pushed quite hard at the moment. I think it's affecting the lower pay grades more so than anyone. And I think people are just using any spare cash they've got, really, just to put towards basic daily living.
It's just the latest in a long list of hits to consumers and businesses.
I think the increase is going to add significantly to our pressures in the industry. We've seen massive hikes across the board in all costs, and this is just like a further kind of kick in the teeth for us.
Government figures released today show there are now 1.5 million more people living below the poverty line in working households compared with after the financial collapse of 2008, with these figures expected to get worse with the cost of living squeeze. There is also an increasing question mark over the impact of the 11 rate rises on homeowners, most of whom have been insulated by fixed-rate mortgages until now.
We've been in a position now where wages haven't been keeping pace with inflation anyway, so people have been forced to eat into savings or to run up debts. This is likely to make that worse. It's definitely going to be very difficult for people who are coming to remortgage. People who fixed 5 or 2 years ago were more likely to be on something like 2%, whereas now when they're remortgaging, they're looking at something like 5%, and that's a massive increase in their outgoings.
Despite these concerns, the bank's decision today actually underpins an uptick in confidence about the UK economy and flies in the face of some of the panic that has gripped markets in recent weeks.
Back at the beginning of February, we were really a bit on a knife edge as to whether there would be a recession. Certainly we thought the economy would be quite stagnant. I'm not saying it's not off to the races, let's be clear, but I'm a bit more optimistic now on that front, yes.
It's not the Grand National, but in Liverpool they'll be hoping that confidence is well placed and the call to continue with interest rate jumps will be the right bet.
Helia Ebrahimi reporting there. I'm joined now by Jumana Salahin, who's Chief European Economist at investment firm Vanguard, who's previously a senior leader at the Bank of England. Jumana Salahin, the Bank of England governor there, saying he's much more hopeful now. Is he right to be, do you think?
I think hopeful in terms of, the economy has been resilient. We've seen surprises in the labour market. It's been stronger than expected. Growth outlook looks to be stronger than expected. But the bad news is inflation's also been higher than expected, which is why we've seen this interest rate decision today. But hopeful in the sense that we, might see a stronger economy.
And do you agree that we could avoid a recession entirely or not?
In terms of our view is that we did actually price in a mild recession this year. We still sort of see that happening. I think, interest rates have gone up again today. And we know that potentially credit conditions may have tightened as well.
Because of the financial turbulence.
Because of the banking sector stress, there's been stress in banks, and whether that's true or not true, or what's going to happen next, what happens is banks which are a little bit more nervous, a bit more conservative, might say, hey, actually, should we be precautionary and should we maybe tighten our credit conditions? We don't know yet. We haven't got the data. It's too early.
But there are economists who say, well, the combination of the rate rise today and the financial turbulence means that there will be a recession after all, and the bank will end up being wrong again. Do you share that concern?
I think, I don't know really yet what's going to happen. There's a huge amount of uncertainty, Kathy, going forward. So, we can't be, at the moment, we have a mild recession. I think sometimes people focus too much on zero recession, one not. Well, actually, it's really flat growth that we're talking about.
So it's not anything to be really excited about. I mean,
No.
I was talking about rose-tinted spectacles, but actually it's a very insipid growth, isn't it?
Yeah, absolutely.
The 11th consecutive rise. I know you've said there's a lot of uncertainty, but how soon do you reckon it might be until the bank has to actually cut rates, or at least is this the top now?
Our own view at Vanguard is that interest rates are going to have to go up a little bit more. We see the terminal rate at 4.5%, and thereafter we see rates being held at that level. Not cut, well into 2024.
Right. Just coming back to that inflation point, it does appear perhaps that inflation is sort of stickier, more persistent in the UK than in other countries. Why do you think that is?
I think there's a number of reasons for that. First of all, we're a small, open economy. That makes us more exposed to international shocks, such as the energy crisis, but also during the COVID pandemic, goods prices were very elevated, and goods is a tradable good, so we're a little bit more exposed to that. And at the end of the day, inflation is all about demand and supply, and the supply side of the UK economy is looking poor relative to our counterparts. So that's always bad news for the long-term inflation outlook as well.
Brexit has a part to play?
Brexit probably has a part to play. There's been a lot of studies which shows that it reduces the supply potential of the economy because we're losing our biggest trading partner.